The implied volatility, the Vega on TSMC, that's TSM, is pricing in a massive, potentially catastrophic swing right now.
Oh, absolutely.
We are talking about today's Q4 2025 analyst meeting, January 15th, 2026.
And if you are long premium here, you are walking directly into what we call the Vega trap.
You really are. And the clock is just ticking down to the opening bell.
It's an absolute textbook set up for premium sellers, but the risk reward for anyone buying calls or puts it's just distorted. It's almost disastrous.
Yeah, the market narrative is completely front-run any good news.
Completely. Look at the data we had this morning. The analysts have set the bar impossibly high.
Right.
Goldman Sachs, for instance, they didn't just tweak their target. They lifted their price target by a staggering 35%.
35%.
To NT $2,330, and that was ahead of this meeting.
So that just pulls forward, weeks, maybe months of positive sentiment into one single event.
Exactly.
Which means the market expects perfection and then some.
And Morgan Stanley's research just confirms this. They didn't just offer one scenario, they outlined 3.
Okay.
And even their base case, which is highly optimistic, it assumes TSM guides for, a robust mid-20% revenue growth for 2026.
Which is a huge number.
A huge number. And that only projects a rise of 2 to 3% in the stock.
Only 2 to 3%.
That's it. This isn't priced for a win, it's priced for a flawless victory with, bonus points on top.
Precisely. We are witnessing that classic dynamic where the upside delta from good news is already baked into the price.
Right. But the downside, Vega, that risk premium for uncertainty, is still massively inflated.
And this binary event just creates the perfect IV crush scenario.
It does. Whether TSM meets that lofty mid-20% growth or barely exceeds it or even disappoints slightly, the volatility that's baked into those options is going to deflate immediately because the uncertainty is gone.
Right. So the highest probability play here is just that rapid, aggressive theta decay.
That's the edge.
The market has fully digested the good news before it's even been confirmed.
Yeah.
It's turned a catalyst into a certainty, and that always leads to a vol crush.
But, and this is where the Greeks demand discipline, you absolutely have to manage that downside risk.
Oh.
The real danger zone, the scenario that sellers need to hedge against, is if that guidance comes in weaker than Morgan Stanley's base case.
So what does that look like?
Let's say we see a guide for, low 20% revenue growth, a number that in any other environment would be considered incredibly strong.
Sure.
That would trigger a sharp, violent, Vega-driven sell-off.
And why is that? Just because the IV has baked in such massive expectations.
Exactly. The expectation is for high 20s. If the reality falls short, that whole bubble bursts, and it crushes the stock price even if the numbers are technically good.
So that low 20% guide is the trigger.
It's the trigger for aggressive downside delta and a rapid expansion of volatility, but in the wrong direction for anyone who sold, say, naked calls. It's a nuanced risk, but it's the one that dictates the whole strategy this morning.
That structural risk profile is exactly why we focus on the theta edge today. We have to connect this PSM volatility to the broader macro theme. The structural driver of the market is AI infrastructure.
It is.
And TSM's colossal projected capital expenditure, which we're going to unpack in a minute, is the ultimate confirmation that this boom have years left to run.
It really is the main story.
Now, we do have some localized volatility spikes hitting the tape. We're dealing with the big bank earnings, Goldman, Morgan Stanley, BlackRock, and the 8:30 a.m. retail sales data. These are crucial, for sure, but they're often quick, sort of ephemeral volatility events.
Those are your classic 0 DTE, your 0 days till expiration, IV crush setup.
Exactly. In the SPY or the IWM, you just fade the vol spike, you bank the premium, and you move on.
But the TSM event is it's fundamentally different. It's structural. It's defining the capital spending trajectory for the entire global tech sector for the next several quarters.
So while bank earnings are, a classic short-term IV crush play.
Right. Sell premium into the catalyst.
The story today, the one that really sets the tone for 2026, is TSM's CapEx guidance.
And what it says about the unrelenting demand for advanced silicon.
And for anyone tracking global markets, a crucial piece of context. The Indian markets, the NSE and BSE, they're closed today for elections.
Right.
Which means institutional focus is absolutely laser-focused on these U.S. pre-market catalysts, TSM and that retail sales number. We have a clear field of fire for analysis.
This is where we focus our energy. And our Greeks.
Welcome to Theta Fuse, your daily edge in time decay. I'm Maya, and that's Gotham. Let's get back to the tape and the data flow.
Let's do it.
So we're starting our strategic deep dive with Section 1, the AI supply chain king, TSM. The foundation here, the macro argument, is just rock solid.
It is.
The AI boom is not some cyclical burst of spending. This is a multi-year secular growth engine.
Right.
You've got hyperscalers like Meta, Amazon, driving this unrelenting demand for Nvidia accelerators. And TSM is the irreplaceable essential foundry. They are at the absolute center of this entire ecosystem.
And that enduring outlook is really the only thing that calms those lingering concerns about, the sustainability of all this data center spending.
Exactly. And that sustainability is quantified in the latest TSM data. The numbers coming out are not just large, they're astronomical.
Right. They're signaling this extreme confidence in the longevity of the cycle. TSM is earmarking up to $56 billion in capital spending for 2026.
$56 billion.
Think about that figure for a moment. That's more than the GDP of many small countries.
It's incredible.
That level of capex shows they're not seeing any softening of demand. Quite the opposite. They're building for exponential growth that stretches out over, the next 5 years?
And you have to look at that capex in context to really get it.
Yeah.
This spending is primarily focused on the most advanced nodes, 3 nanometer, 2 nanometer, and crucially, on advanced packaging like CoWoS, which we'll get into.
Which is the real bottleneck.
It is. Historically, massive capital spending cycles in this industry always precede a major tech transition. This $56 billion isn't just about maintenance.
No.
It's aggressively locking down their technological lead and ensuring no competitor can catch up in the AI space.
And what's fascinating here is the sheer dominance the market has just accepted as fact. TSM held an incredible 72% share of the foundry market in Q3 of last year.
72%.
That kind of market share in the highest growth tech sector means that every major player, Nvidia, AMD, Broadcom, Apple, Qualcomm, they all rely fundamentally on TSM.
They have no choice.
The demand is so acute that the fabs for advanced chips are reportedly running at absolute full capacity.
Which justifies this aggressive forward guidance.
It has to. And crucially, this massive spending isn't expected to derail profitability, which is the truly astonishing part of the guidance. CFO Wendell Huang has actually raised the long-term profitability guidance. He now sees a 56% or higher sustainable gross margin over the long run.
56%.
When you think about the scale, TSM surpassed $100 billion in annual revenue for the first time in 2025, operating at a 56% gross margin floor while funding $56 billion in capex.
It's a level of scale and efficiency that is, unmatched globally.
It's the ultimate expression of pricing power.
It is.
TSM's ability to demand that kind of margin floor while spending so aggressively is a structural advantage, and it's derived from technological scarcity.
They're advanced nodes, right? The 7 nanometer and below.
Yeah, they already accounted for a staggering 74% of their wafer revenues in Q3. And these nodes command premium pricing because, they're the only game in town for the most performance-hungry AI chips.
And the expectation embedded in all the analyst projections and in this guidance is that the utilization rate of these fabs will stay near 100%.
Because of accelerating AI demand?
Right. And that utilization rate is the secret sauce for the margin.
It is. They're front-loading the cost of the capex to secure future, highly profitable, sticky revenue streams. They are literally buying their moat.
Okay, Gotham. This is where I have to toss you the Greeks challenge. The knowledge gap rule.
Let's hear it.
That $56 billion capex projection is clearly a massive delta swing factor. It screams growth, future revenue.
Sure.
The market loves growth. But historically, we know huge capital expenditures compress margins short term. Building costs, ramp-up expenses, depreciation.
Right, the drag.
But what if TSM cannot maintain that 56% gross margin floor while spending so aggressively? Doesn't that expose them to significant short-term delta pressure, regardless of the long-term demand?
That is the essential skepticism, Maya, and that's the right question. The only way TSM can possibly bridge that margin gap is through proprietary process tech and just pure, unadulterated pricing power.
So it comes back to scarcity.
It all does. Their gross margin floor is a promise. And it's predicated on the assumption that demand for their latest nodes, especially N2 and A16, will exceed supply for the foreseeable future.
And if that changes?
If their process lead over, say, Samsung or Intel shrinks even slightly, or if that utilization rate drops even 5 points, That 56% floor becomes highly questionable. The delta of growth is huge, but the theta of execution risk remains.
That structural hedge makes sense. It's an investment in the moat. And Jensen Huang, Nvidia CEO, he really hammered this point home recently.
Yeah.
He confirmed that Taiwan is still the indispensable center of the advanced chip future. He views reshoring efforts in the U.S. and Europe as just insurance, not replacement.
That insurance not replacement comment is a classic CEO line, but one that investors really need to absorb fully.
What's the subtext there?
It confirms that TSM's advantage isn't just tied to being able to produce at a 2-nanometer scale. It's spearheaded by a potent, decades-old ecosystem.
Right, the clustering of suppliers, the packaging.
The talent pool, the speed of iteration. Even with U.S. and European capacity expected to triple by 2032 because of all these subsidies, the entire supply chain velocity remains concentrated in Asia.
So the implication is clear. The geopolitical Vanna risk, which we'll get into later, is still the primary non-quantifiable threat to TSM.
It's not competitive execution risk from Intel or Samsung over the next 3 years. It's geopolitics.
And the demand forecast alone for AI is just staggering. It provides the whole foundation for TSM's confidence.
Nvidia is projecting global data center capex will rise from $600 billion in 2025 to somewhere between $3 and $4 trillion by 2030.
3 to 4 trillion.
These are not small conservative estimates. These are projections from the companies who have visibility years out because their customers, the hyperscalers, are placing orders for computing units that haven't even been released yet.
And that visibility gives TSM enormous leverage.
Absolutely.
If TSM's AI accelerator demand growth rate, which they expect to be mid-40s CAGR through 2029, if that just stays intact, then that margin guidance seems not only achievable, but maybe even conservative. They're the toll booth on a multi-trillion-dollar highway.
That's why analysts are calling AI a key driver of earnings growth for Asian equities. The money is flowing through Taiwan, and TSM controls the gates.
It's also worth thinking about how this CapEx budget relates to the energy transition.
That's a good point.
Advanced chips are vastly more power efficient. So this $56 billion investment ensures that new data centers are using the most efficient silicon possible.
Which helps mitigate the massive energy demands of the whole AI build-out. It indirectly protects TSM from future energy-related cost pressures and, regulatory headwinds.
And it leads to the sophistication of their investment cycle. They're not just building capacity, they're upgrading the quality of the capacity.
Right. The $56 billion is a signal that the market has shifted from general processor demand to specialized AI demand.
Where only TSM has the tech and the scale.
For now, yeah. So on TSM, the immediate theta trade is the vol crush post-announcement, but the long-term investment profile is built on an unassailable moat backed by $56 billion in commitment.
That defines the first wave, the core hardware. Now, we have to move quickly to where that hardware is being deployed for profit.
The application layer.
Exactly. We've established TSM as king of the chip wave, the first and most expensive leg of the build-out. The question for traders now is, what's the next frontier?
Where are the outsized returns?
Let's pivot hard to Section 2, the second wave. If the first wave was about building the physical data centers, the second is about plugging AI into other sectors. And finance is the biggest target.
Right. This is the realm of fintech infrastructure and the rising hype around stocks like Fintech Works.
And this shift is absolutely crucial for finding where the next multi-bagger returns are going to come from.
It is. AI's true strength is its flexibility. It can plug into almost any sector to cut costs and streamline operations.
And finance is the most obvious target.
Of course. At its core, money is just information flowing digitally. And when you think about it that way, you realize the antiquated infrastructure moving that data is the key bottleneck that AI is poised to solve.
The growth story is undeniable. The source material is really clear on this. Analysts now project the AI and financial services market could grow from about $20 billion today to more than $80 billion within the next 4 years.
A fourfold expansion, that's massive.
It makes fintech the central pillar of this second wave of AI adoption.
Yeah.
The biggest profits are potentially moving from the hardware builders to the software architects.
And this is where the market narrative around a name like Works gets serious traction.
Right.
They are positioned as solving a critical systemic infrastructure gap that's been created by decades of legacy development. Traditional banks, legacy payment processors, they're all saddled with fragmented patchwork systems.
It's a mess. Imagine a huge organization using one vendor for compliance, another separate vendor for payments, a third older system for cross-border transfers.
It results in delays, huge operational costs, high failure rates, and increasing compliance risks as global financial regulation gets tighter and tighter.
The technical debt of that legacy system is just astronomical. A simple international transfer might have to go through 3 or 4 different incompatible systems.
Right, and it takes days to settle and costs a fortune in fees.
Warrex aims to replace all that spaghetti code with a single, unified, cloud-native platform.
They're positioning themselves as the indispensable infrastructure play for the movement of money in the AI age.
And they break their value proposition down into 3 pillars, right?
3 core pillars, and each one is directly addressing a major pain point for legacy institutions. Pillar 1 is handling electronic money transfers and payouts at scale.
So replacing the slow, manual legacy rails like ACH and EFT?
Exactly, with faster, more resilient, API-driven transfers, which is essential for modern commerce built on microtransactions, subscriptions, and instant global payouts.
And that speed is just the baseline expectation now. Pillar 2 is where the AI gives them an edge.
The compliance and security layer.
Works provides integrated AI-powered fraud protection and advanced ID verification for compliance on every single account and transaction.
So as volume surges and cross-border complexity increases, security moves from being this tedious cost center to a critical automated differentiator. They're offering compliance as a service.
And Pillar 3 is probably their most potent global hook.
Multi-currency processing.
Right, across everything: cards, ACH, EFT, digital wallets, even crypto, unlocking global reach in over 120+ currencies.
And when you think about the future of AI creating commerce, billions of payments, subscriptions, microtransfers, all flowing nonstop, instantly across borders.
Yeah.
You realize the companies that own these resilient, compliant pipelines are positioned to own the network profits.
The total addressable market is just huge. I mean, think about the rise of digital services.
Right.
A customer in Brazil buys a subscription from a platform in Singapore, which then pays out micro commissions to developers in the UK and India.
And every single one of those capital flows, currency conversions, and compliance checks is where Works aims to be the invisible, ubiquitous infrastructure.
And this infrastructure thesis is what explains the really aggressive early investment comparisons you're seeing.
Yeah, the narrative being pushed is comparing the opportunity to Warren Buffett backing New, the fintech bank.
Right, where Berkshire's stake went on a multi-bagger run.
The underlying belief is that Works, by solving the infrastructure headache for the AI economy, is poised to deliver similar explosive profits.
But I have to bring the technical reality check here, Gotham.
I was waiting for it.
The market narrative is so heavily reliant on comparing it to past winners. It's the myth this, miss the next Nvidia marketing.
It's effective, but it's marketing.
It is. Which brings us to the cynical challenge and the knowledge gap rule. But what if this aggressive retail hype is already inflating the gamma of Works options, making it dangerously speculative before they have proven high-scale recurring revenue?
That is precisely the Greek reality check that a small-cap growth stock like this demands.
So break that down.
Warrex is a small-cap innovator competing against giants like Visa and the entire legacy banking system. High retail enthusiasm drives up volatility, the vega. And critically, it accelerates short-term sensitivity, the gamma. And for our listeners, gamma is the rate of change of the delta. When gamma is inflated, a small move in the stock price causes a massive disproportionate acceleration in the options delta.
Meaning the options chain becomes highly sensitive, almost irrational, and extremely difficult to hedge.
Exactly. If the stock is already moving violently on small news cycles, the options chain is likely dramatically overpriced. This gives poor entry points for long premium players, and it exposes premium sellers to potentially catastrophic moves.
So the market needs to respect the technical reality, not just the narrative.
The execution and the revenue, yes.
Let's deepen the critique then. They're dealing with the immense complexity of global compliance, identity verification, multi-currency flow across 120 jurisdictions. That requires huge regulatory capital. What about the row risk, the sensitivity to changes in interest rates? If the cost of capital shifts, how does that impact a small-cap scale-up competing against legacy banks with massive treasuries and zero-cost funding?
The row risk is substantial in the financial sector, especially for a scale-up.
Explain that.
For clarity, row measures how sensitive an option's price is to changes in the risk-free interest rate. Higher rates mean a higher cost for Works to borrow and fuel its global expansion.
So it can delay investment in necessary tech and compliance.
Right. And it can also mean less attractive terms for the critical white label partnerships they need for accelerated adoption.
Whereas legacy banks, they might be slow and burdened by tech debt, but their low cost of capital is a structural hedge.
They can afford to wait out a cycle. Works needs rapid, sticky adoption and immediate scaling to overcome that structural row headwind.
So the bull case really relies heavily on the stickiness of their platform.
Yeah, the idea that once a major institution integrates Works, switching back would feel like, trading a smartphone for a flip phone.
The cost of switching has to be greater than the savings offered by any legacy system.
It relies on the platform truly being indispensable.
That ecosystem argument is potent, though. Nvidia became indispensable because everyone needed its chips and its CUDA platform.
Right.
Works wants to be indispensable because every high-volume commerce platform needs its consolidated, compliant financial infrastructure.
But we have to be diligent about separating the marketing narrative from the current cash flow reality and the high gamma risk in the options chain right now.
Absolutely. The real money is in identifying indispensable infrastructure, but you have to verify it's indispensable and not just aspirational.
The first wave, the TSM wave, had proven multi-year contracts from hyperscalers. The second wave, Works, needs to deliver those proof points fast.
So the challenge for the listener is balancing the exponential potential of software against the immediate, tangible reality of the physical infrastructure that TSM represents.
Precisely. And that brings us right back to TSM and solidifying the capacity expansion that justifies that massive $56 billion investment.
Okay, let's circle back to the infrastructure king to solidify the long-term outlook. Section 3. Capacity and long-term technical visibility for TSM.
Right.
We're returning to TSM to understand the physical reality that's supporting their aggressive forward guidance and the bullish macro picture for 2026.
And the core technical deep dive here has to focus on capacity. High demand is only meaningful if you can actually monetize it.
And the key to their pricing power, their ability to maintain those 56+% gross margins, is their unique proprietary advanced packaging.
We're talking about CoWoS, chip-on-wafer on substrate packaging.
For our listeners, just break that down simply.
CoWoS is basically the highly specialized proprietary glue that stacks advanced logic and high-bandwidth memory chips together into one incredibly powerful unit.
It's crucial for chips like Nvidia's H100 and the new H200 series.
It is the choke point in the entire AI supply chain. It is a point of physical scarcity that TSM completely controls.
And their expansion plan for this specialized packaging is nonlinear. I mean, it is a dramatic, immediate improvement.
It reflects the insatiable demand from customers and their customers' customers.
So let's put some numbers on this. Current CoWoS capacity is at about 75,000 to 80,000 wafers per month.
Which is already an immense figure.
But by the end of 2026, the planned capacity is projected to surge to an astonishing 120,000 to 130,000 wafers per month.
That increase, nearly doubling the output of this highly specialized high-margin packaging, is maybe the single clearest indication we have that the hyperscalers are not slowing down.
They are buying hardware years in advance, which justifies the $56 billion in CapEx.
And this doubling of CoWoS capacity is TSM's direct answer to the market's question: can you meet Nvidia's demand? It confirms they're prioritizing the highest margin, highest demand part of their business, which supports that 56% gross margin floor. If they can ramp this, it solidifies their irreplaceable status for the entire AI ecosystem.
Locking in revenues through 2028, potentially?
At least.
And that supply commitment confirms the long-term bullish outlook. Beyond packaging, TSM continues to push the limits of core node tech.
Right. They expect volume production of N2P, that's the 2-nanometer extension, and the A16 technologies to start in 2026.
And that technological leap will just trigger another multi-year upgrade cycle in data centers and AI accelerators,
which locks in future high-margin revenue.
This capacity expansion and the transition to smaller, more power-efficient nodes, it just solidifies TSM's long-term theta profile for buy and hold investors.
Absolutely. They're the company that benefits regardless of whether Nvidia, AMD, or Broadcom wins the next contract, as long as the overall spending on AI stays high. They're a leveraged bet on the entire AI thesis minus the competitive risk.
And this micro-bullish story for TSM plays perfectly into the wider macro view for 2026. It provides a powerful backdrop for the whole market. Deutsche Bank, for example, expects the S&P 500 to hit 8,000 points by the end of 2026.
Right. That suggests potential 15% gains from here.
Reinforcing the idea that strong capital spending fueled by AI earnings is the primary catalyst for the broader market this year.
And JP Morgan agrees. They're pointing out that strong capex fueled by AI is going to be the central catalyst for stocks in 2026, moving beyond the consumer strength that drove 2025.
So you have this positive outlook, plus historical market data showing bull markets often stretch, up to 8 years after the 3-year mark.
It provides a powerful macro foundation supporting high-quality, high-growth infrastructure plays like TSM.
So if the underlying trend is 15% growth, the structural tailwinds for TSM are immense. But we have to address the elephant in the room.
The geographic concentration, the unquantifiable threat.
Exactly. Gotham, final knowledge gap rule before we get to the trade.
Yeah.
TSM's accelerating demand and massive investments create huge opportunity. But the geographic concentration in Taiwan is the core unhedgeable risk. But what if the mention of broader global instability, like the U.S.-Venezuela conflict in the sources, highlights the actual non-quantifiable vanna of geopolitical events? Does this prove the biggest risk isn't competition or a capex miss, but something external and unhedgeable?
That is precisely where the real risk premium lies, and it's why Jensen Huang's comment about U.S. reshoring being just insurance is so telling.
So talk about vanna.
Vanna, technically, is the sensitivity of an option's volatility to changes in the underlying price. But in TSM's geopolitical context, you can think of it as the volatility of volatility.
The market's sudden, extreme sensitivity to external systemic shocks.
Exactly. Geopolitical flare-ups like the U.S.-Venezuela conflict or any escalation in the Taiwan Strait introduce unquantifiable vanna risk that even the most sophisticated quant models cannot price efficiently.
Meaning the stock's price is directly sensitive to the perceived stability of the region.
Which is entirely beyond TSM's operational control. A major geopolitical event, even a non-military one like a trade embargo, would instantly raise the implied volatility of TSM options by orders of magnitude,
causing rapid delta changes that move the stock violently.
And the volatility isn't driven by earnings or capex anymore. It's driven by the perceived stability of the kingdom. That's why investors need to be constantly aware of the tail risk, even if the operational execution is perfect.
So for leading-edge semi-capacity, TSM is the king.
But that kingdom resides on volatile ground, making it a high vanna stock.
That's a powerful summary of the trade-off. Unparalleled technological advantage versus unparalleled geopolitical exposure. The $56 billion capex is critical, but the geopolitical backdrop is the enduring risk.
It dictates the long-term premium required for holding the stock.
Okay, let's pivot now to the action plan. Based on all this pre-market data, our immediate focus is capitalizing on that volatility crush that's going to hit TSM post-announcement today.
This is the theta edge trade. We are capitalizing on the defined, expected move surrounding TSM's meeting. Since the IV is currently inflated because of the binary event.
Will they hit the forecast or not?
Right. We want to sell that bloated premium before it just evaporates due to theta decay.
And the chosen strategy is the Iron Condor, expiring next week, or any short duration, say 7 to 10 days out, where you feel comfortable managing the risk.
The strategy involves simultaneously selling an out-of-the-money call spread and an out-of-the-money put spread. The goal is simple. Harvest the maximum time decay, the theta, once the news is out and the IV drops.
And for technical placement, how do you do that?
You have to calculate the exact expected move from the current pre-earnings 5e. For example, if the options chain is suggesting a 6% move in TSM, you want to place your short strike wings outside that calculated move. You might target your short strikes at 7 or 8% out on either side.
So you capture inflated credit on both sides, define your max risk with the long wings, and you're betting the announcement won't push the stock beyond those inflated expectations.
Exactly. The resulting IV drop and subsequent theta decay should make those short spreads worthless pretty quickly, letting you buy them back for pennies on the dollar and bank the premium.
But discipline is vital here.
You have to be ready to adjust quickly post-guidance. If TSM guides weak to that low 20% number, the stock will likely crash into your put side. You need to be ready to defend or roll that position immediately.
And on the upside.
Conversely, if they guide high 20% revenue growth and raise the AI CAGR to, say, 75%, it's going to challenge the call side.
So a condor requires hands-on management.
It does. But the inflated premium you earn today should reflect that necessary risk.
So the TSM story really confirms that the market is structurally bifurcating in 2026. You either own the irreplaceable hardware infrastructure, TSM, the physical scarcity, or you own the indispensable software infrastructure that scales money flow, like Works, the digital velocity.
The second wave of AI in fintech is the next front line. It forces traders to choose. physical pipelines or financial pipelines.
So the final provocative thought for you to consider as you position yourself for the rest of 2026 is this. Which camp will generate the biggest delta moving forward?
Is it the compounding regulated growth of physical scarcity TSM's advanced nodes and the need for $56 billion in CapEx to scale? Or is it the exponential high gamma scaling of pure software adoption works' unified fintech platform? It's a choice between manufacturing might and digital velocity, and the answer will dictate where the most profound theta decay opportunities will emerge over the coming years.